The Netherlands economy in the second quarter, slow GDP growth rate shows a time when the economy barely grew. It highlights how the economy is moving from getting better after the pandemic to growing much slower. This is because people aren't buying much, and businesses are being careful. In the second quarter of 2025, official numbers showed that the economy grew by only about 0.1% compared to the previous quarter. This is a big slowdown from the small gain in the first quarter and means that things like people buying stuff and businesses investing have slowed down a lot. People's spending really slowed down in the second quarter. They bought less of things they don't absolutely need, like eating out, clothes, and fun activities. This is because prices have been high, and people are more careful with their money since borrowing costs went up earlier. Businesses didn't invest much, even though there was some growth in green energy and transport projects. Overall investment went up a little, but it wasn't enough to make up for people buying less and businesses not stocking up as much. In the second quarter of 2025, the economy faced a broad slowdown. Net trade weakened as imports outpaced exports. The job market softened, with unemployment rising to around 3.9%. And while headline inflation eased to about 3%, sticky service costs and slow wage growth limited purchasing power. Monetary conditions remained tight. Linked to the euro area, our short-term bank rates hit 2.0%, making credit expensive for businesses and slowing investment. The government faced fiscal constraints, with debt to GDP in the low 40s, limiting its ability to stimulate the economy. The slowdown was widespread, affecting manufacturing, construction, and retail, though some high-tech sectors remained resilient. Downside risks included a European slowdown and energy price shocks. However, upside potential existed through targeted government spending on infrastructure and green energy, which could help restore stronger growth. Policy options are limited but clear. Calibrated short-term support for households and businesses, combined with long-term reforms. Focusing on skills, technology, and infrastructure is crucial to boost productivity and turn the slowdown into sustainable growth. This quarter, the main economic activity barely grew, showing a very slow expansion. The real GDP, which is how much our economy grew, was only about 0.1% in the second quarter compared to the first. The good times slowed down for both how much people spent and how much businesses invested. People weren't spending as much as before, especially on things they didn't really need. We saw a noticeable drop in spending on things like eating out, clothes, and fun activities. Businesses didn't invest much even though green energy showed some promise. Building roads and bridges helped a little bit with creating new wealth. We sold more goods to other countries because we're really good at making special, high-quality products. Overall, other countries bought less from us. We bought more from other countries, which meant we didn't benefit as much from our sales abroad. The job market got a bit weaker, with unemployment going up to almost 3.9 to 4%. Many people were still working, but their pay didn't grow as much when you consider how much prices went up. The interest rates banks charge each other for short-term loans went up to about 2%, making it more expensive to borrow money. This meant banks made less money, and small businesses found it harder to get loans. Our country's economic rules followed what Europe was doing, so we couldn't easily make things cheaper or easier here. Prices didn't go up as fast, with the main inflation rate dropping to around 3%, but prices for basic services stayed high because wages and housing costs were still going up. The government spent a little more than it took in, but it wasn't a huge problem. The country's debt compared to its total economic output stayed around the low 40% mark. The slowdown affected most parts of the economy, but some industries felt it more than others. Making things, building things, and services all slowed down, but shipping and digital services kept going strong. Business surveys showed that companies had fewer new orders and made less profit. Companies still planned to invest in robots and ways to work smarter. It became harder to get loans because banks were a bit stricter about who they lent money to. Businesses used their own money more, which meant fewer new projects got started. We didn't have much money left over from trade because we bought so many things from other countries. Changes in how much our money was worth compared to other countries' money only helped us a little bit. Bad things that could happen include Europe buying less from us and energy prices going up again. On the bright side, if the government helps certain areas and makes things easier, our economy could pick up speed again. We should focus on investing, teaching people new skills and finding ways to make work more efficient. The slowdown shows that people aren't buying as much, and businesses are being careful. Families spent less, especially on things they didn't absolutely need, across many different areas. Businesses didn't invest much more. Even the growth in green energy wasn't enough to make a big difference. Selling goods to other countries helped some parts of the economy, but overall, other countries weren't buying as much. More people were out of work, with the unemployment rate going up to about 4%. This means there were more available jobs than people to fill them. Even though people's paychecks might have looked bigger, they couldn't buy as much because prices went up faster. This made people spend less. It was harder and more expensive for small and medium-sized businesses to borrow money. While overall price increases slowed down, the cost of services, like haircuts or repairs, stayed stubbornly high. The government spent a little more than it earned, which meant it didn't have a lot of extra money to give the economy a big boost. The slowdown affected many different parts of the economy, but not all in the same way. Factories, building and stores, all saw things slow down. Businesses said they had fewer new orders, but they still planned to invest in new machines and technology to make things more automatic. Banks were a bit stricter about who they lent money to, so less money was flowing into the economy. There are more risks that things could get worse, but putting money into specific areas could help. The government needs to help the economy right now, but also make plans for the future to help businesses produce more efficiently. For more data-driven insights and global market breakdowns, make sure to subscribe and turn on those notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.